Hello and welcome back to Trade with Alicia. Today we're going to dive deeper into call options, a fundamental concept in options trading. If you're looking to profit from a stock's price increase without buying the stock outright, call options might be just what you need. Let's explore how they work. A call option is a contract that gives the buyer the right, but not the obligation, to buy a specific stock at a predetermined price, called the strike price, before a specific date, the expiration date. Let's break it down with an example. Imagine you're at a farmer's market and you see a vendor selling apples. The current price is $1 per apple, but you think the price will go up next week. The vendor offers you a deal. For 10 cents, you can have the right to buy 10 apples at $1 each next week, regardless of the actual price then. This is similar to how a call option works. The 10 cents is your premium, $1 is your strike price, and next week is your expiration date. So, what are the possible outcomes? If the apple price rises to $1.50 next week, you can exercise your option, buying 10 apples for $10 when they're worth 15. If you resell, your profit is $5 minus the 10-cent premium, so $4.90. If the price stays at $1 or goes down, you might choose not to exercise the option. You lose your 10-cent premium, but you're not obligated to buy the apples. Now let's look at a real stock market example. Suppose Apple Inc. AAPL is trading at $245 per share. You believe the price will go up in the next month. You decide to buy a call option with a strike price of $250, expiring in 34 days, for a premium of $5.05 per share. Each options contract represents 100 shares, so your total cost is $505. If AAPL rises to $260 by expiration, your option is worth $15 per share. Your profit is $995, which is $1,500 minus $505 of the premium. If AAPL stays below $250, your option expires worthless and you lose your $505 premium. Now, why do traders use call options? Leverage. Control more shares with less capital. Limited risk. Your maximum loss is the premium paid speculation. Profit from price increases without owning the stock. Hedging. Protect against potential price increases in stocks you need to buy. However, remember that options can expire worthless, and you can lose your entire investment if the stock doesn't move as expected. To summarize, call options provide a way to benefit from a stock's price increase with less initial investment and with limited risk. They're versatile tools that can be used for various trading strategies. And that's it. Now you have a solid understanding of call options. If you found this helpful, be sure to like this video and subscribe for more trading insights. Thanks for watching and happy trading. Our next video will explore put options in detail.